Hello everybody, welcome to your TraderMerlin show for, is it Wednesday already? It is Wednesday. That's absolutely Wednesday. I hope you all enjoyed the announcement today by the FOMC, which will be our topic du jour. Again, for anybody who might be new, we do the show Monday through Friday at 2 p.m. Pacific time, so hit that subscribe button down near the bottom so you're alerted when we do it. And of course, the thumbs up if you like what we do today on the show. So here's what I'm going to talk about. We'll try to rip right into things, go over the FOMC, do a whole bunch of market overview, and I've got people asking about different charts, so let's check those out. Here is our graphic for today. I wanted to pick something somewhat ominous, a little dark, evil-looking, classroom here, and in secrecy, as the FOMC meeting minutes usually are. Of course, we get what I'm assuming to be cherry-picked information from the FOMC meeting minutes, and then that gets conveyed onto us, and hopefully we react to it as we did. So it brought up a good question that came in from Les, and this was, of course, on the YouTube video. So if you have questions that you want me to answer, not during a live show, put them underneath the YouTube video. If it's live, just answer them or send them in the chat with some question marks. So here's the question that came in from Les. He says, what's the meaning of today's trading after the Fed minutes? So let's start with what the meeting minutes themselves conveyed to everybody. As we talked about yesterday with Bill Addis, clearly there's the expectation that the Fed is going to be far more aggressive going forward. Therefore, you're seeing the forecast, at least by traders putting their money on the line, that rates are going to be much higher. So here's what we have as of today for the December 14th meeting of this year. And you can see that there wasn't really much of a shift. There was a slight increase over yesterday's numbers in the probability of there being 12 rate hikes this year, which is very interesting. But all in all, not a major shift between today and yesterday. So it was kind of all priced in. But you notice definitely a month ago, clearly a huge change in those numbers. So the expectation, I believe, has already priced this in. And part of me thinks that this is all rigged and that the members of the FOMC have leaked out their plans or these meeting minutes to financial firms first so they could get on the futures market and therefore buying all these futures products with the expectation that this is what's going to be happening. Now, of course, we don't know. The Fed has said very clearly we are going to be data dependent. Okay, what does that mean? Well, it means that they're going to be watching the key metrics of inflation, growth, and unemployment. Those, the trio there, if you will, which I've been going over on the first of the month, looking at it from a stagflation perspective. And is there really an argument for stagflation? At this point, I would say no. But that may change, and of course, they might have to be a little bit more aggressive. Now, what was noteworthy about this wasn't necessarily that they were going to maybe do some 50 basis point increases at this upcoming meeting, which is already priced in. And let me show you that one. If we look at the May 4th, right, so that's our next meeting. We got about 1 month till the Fed has their next meeting. You can see there's an 81% chance as of today that we're going to see a 50 basis point increase at that meeting. I don't think that's a surprise to anybody, really. I would hang my hat on that one as well, saying we'll see a 50 basis point increase at the next meeting. And no surprise. And we saw a month ago it was only 27%. Now it's 81%. So all cards or everything is really leaning in that direction of a much, much higher rate environment going forward. But we'll have to wait and see if anything changes between now and May 4th. What we do know is there were some pretty significant moves in not only the equity markets, but the bond market. The bond market was of interest to me. For those of you who are looking at 30-year fixed under 3%, ain't going to happen. It's not going to happen. What we're seeing now is you can get a 30-year fix for 5%. That's the new benchmark. We've jumped above the 5% mark for 30 years. You might still be able to find them for under 4 at certain places, but from what I was reading, the average is not going to be at 5%. So that's going to be difficult for some homeowners or at least new buyers. Here is the bond yields today. Now, most of the big move happened yesterday, right? That was the gigantic move from 2.4 to roughly 2.55%. That's huge, right? That's 15 basis points. That is a significant move in one day. But this is that 10-year, and you can see it today had that nice little spike up. Now we're kind of in the new session, just kind of hesitating right around 2.598. Great question, Brian. So we'll get to that. We'll get to when they start buying. That's a good, or start not buying, but start unloading their balance sheet. So this is the rate increase impact on the yield. Now, why this went up so much? really goes to what Bill Addis was talking about in yesterday's show. Remember, a large focus for what Bill's talking about is we are now going to have a situation where the Fed has accumulated this $1 trillion balance sheet, $1 trillion plus balance sheet of treasuries and bond products, whether that's mortgage-backed securities, they've got 10 years, they got short-term treasuries. They created all the money to buy that out of thin air. They literally went to a ledger and said, we need how much? $120 billion a month? Okay, we'll just put it in an IOU bucket, right? And at some point, that money's got to go back. So now the Fed is tasked with unwinding that balance sheet. Not necessarily all of it. Some of it will expire at maturity, but some needs to be sold. So the expectation was kind of bouncing around as to when they're going to start, how much they were going to taper each month. And it sounds like it's a general consensus. To Brian's point, when are they going to start? The announcement hasn't been made yet. But the FOMC meeting minutes of the March FOMC meeting was really outlining, look, probably in May. In May, we will probably get a very clear cut, here is our plan. And remember, Powell said this last time at the press conference. He says, we are coming up with a plan. Hello, Lori. Good to see you. We are going to see a plan for the unwinding this balance sheet. And the expectations that I'm hearing are $60 million worth of treasury, or $60 billion worth of treasuries, and $35 billion worth of mortgage-backed securities per month for a total of $95 billion a month. The Fed will be unwinding their balance sheet. Now remember, when they sell those securities, in theory, they're going to take the proceeds from that and pay back what they borrowed. So that is removing money from money supply to the tune of $95 billion per month is being taken out of dollars in circulation. Now, of course, we know we've got tens of trillions of dollars in circulation, but if we take a peek at this dollar chart right now, here's your Dixie, which I am still bullish on. I still think the dollar, as of yesterday's close, had a breakout, and we are following through today. So I think you're going to see the Dixie at 100 here probably by the end of the month. Actually, could be the end of the week here, actually, the way this thing's moving. But yeah, I think you're going to see the 100 mark challenge here pretty quickly. That trend is awesome. That trend is just lower or higher highs, higher lows. Look, go long dollar-denominated assets. Now, what's interesting about this is many of you believe and have been led to believe that when we have this type of environment, a raising rate environment, we have a high inflation environment, that your dollar, it just loses its purchasing power. It might lose its purchasing power depending on the growth of the dollar itself. Now, if we look at this chart, it's clearly telling you that the dollar is getting stronger. And as long as the dollar outpaces inflation, you should keep dollars. I know it sounds crazy, but as long as the dollar's annual growth rate is higher than inflation, you should keep your dollars. Now, let's just go over the past year and see what the dollar has done. And I'm going to try to do 365 days. So this is going to be, actually, this is not exactly right. It should be 210. So let's go with 210. So the dollar in the last 210 bars, which is, I think, the number of trading days in the year, something like that, 210, maybe some of you guys might know clearer. It's not 365 because you get all the holidays, you got the weekends, but it's roughly 10%. That's beating inflation. So this kind of flies in the face of what we learn in economics and basic schooling, which is, hey, if we have an inflationary environment, your dollar is going to lose purchasing power, so get out of dollars. Well, that's not exactly true in this situation. We are actually seeing the dollar showing gaining enough that it's offsetting the cost of inflation and actually giving you a rate of return above inflation to a tune of about 2%. So I wanted to share that one with you because I think that that's just a misconception out there, and that you have to dump dollars and get out of dollar-denominated assets. In theory, it should normally be drifting down, but as John O'Donnell would say, it's the prettiest girl at the ugly girl dance. I know. Sorry, ladies. That is probably very offensive to some. It's the prettiest guy at the ugly guy dance. How about that? We won't take offense. Will we, guys? Hold your cash. Looking for property. Should I hold cash? Ooh, goodness gracious. Naomi, you just threw me a curveball there. You know, this is something, Diana Hill built some really cool spreadsheets for Online Trading Academy. I don't know where they are because I know OTA Real Estate had to be put on pause for the whole FTC thing. But to answer that question, you have to ask yourself about 5 other ones. Let's see if I can remember get all 5 in my head here because I'm doing this live. Not like Jim Cramer where it's all pre-rehearsed questions. We're going to do things live see if my brain works here. So hold your cash, looking for property, should I hold cash? You have to ask yourself, is the cost of me holding US dollars going to appreciate more than a piece of real estate? So in the price of real estate appreciation, we've already seen, 18 to 20% year over year growth in real estate prices. Let me see if I can find you some more recent numbers. It'll take me just a second here to bring it up. But there's two factors there, because it's not just, is this property going to move up? Are we going to see the value of the real estate move up higher than the dollar? Now, if you look at the status of the housing market, it has been, I would say, very overbought. It is being driven by this cheap money. So let me see if I can get you some housing price numbers here now. Because if you look here, this Case-Shiller Composite 20 Home Price Index, which is the kind of taking an average of the 20 major metropolitan areas, here's a chart of it. I just got to ask you, do you think this is going to continue, right? Do you think that this is going to move up today, or much more? And I'll go back even further till we can go back to glory days, when things were ripping in 2005, 6, 7. This is your housing prices. I don't know. I just don't see the housing market sustaining a 19% growth. So my concern is, and I'm actually in your camp, Naum, I would like to buy some real estate, because there's two numbers. There's the price of the house or land that you're looking to buy, which is inflated. Hands down. Anybody who owns a property right now is like, you're rubbing your hands going, this is great. It's only great until you sell, right? When you sell, then you have actual gains. Right now you have paper profits. So you have an elevated housing market, but you also have a really cheap mortgage market. I mean, getting a 30-year fixed rate mortgage for under 3% is like unheard of. My father's a real estate agent, and if I told him 10 years ago, hey, you know what? I'll bet you I can get a 30-year fixed rate mortgage at under 3%. He'd be like, Merlin, I'm going to ask you to put down your bong, stop smoking that crack pipe, because you're crazy. There's no way that's going to happen. And here we are all of a sudden in a situation where we were under 3%. And just so you know, let's bring up the chart here. And I'll bring up the 30-year. Most mortgages are priced off of the 10-year, which, back in this part here, like in 2020, you could have gotten under a 3% 30-year fixed. Clearly, that is changing aggressively, right? So when you look at a mortgage, it's going to be the 10-year plus a little premium. Right now they're saying about 5% for a 30-year fixed mortgage. So, I have to look at it as, A, am I going to get enough appreciation dollar-wise or percentage gain out of the property? And does it make sense for me to wait maybe and let housing prices fall 10%? But then all of a sudden I have to use a mortgage that's going to be higher, right? Instead of a 3% 30-year fix, I might be getting a 6%. Well, depending on how much you borrow, that is a significant amount of capital. So it's not a simple answer there, Naum. It really is not. It's not like just hold cash, right? I've mentioned this before, and I talk about this in the CIL. I think that there are digital areas, which I am a big fan of, that you can park your cash and be making, 20%, no, 19.4% without really taking on a huge amount of risk. Whereas if you keep cash, you're going to have dollars when you're done, but it's going to be chipped away at inflation, and it's not really growing. You can be generating interest on dollar-denominated stablecoins. I think Lori just said here she bought some, what'd you say? Went on the dark side and bought some stable USD today. Cool. Well, Lori, take that money, park it somewhere where you're getting interest on it, and now you're going to have the strength of the dollar, right? You will maintain that dollar. So if the dollar continues up and getting us 10% per year, but inflation is 8%, great. Then you're making a 2% alpha over inflation just by holding dollars, if that makes sense. If that doesn't make sense to anybody, let me know, because I think that's really important. If inflation's 8%, but your dollar has moved up 10% in value as a currency, then you've alpha 2%, right? You're 2% above inflation. But if you can now get 19% on top of that, so you have 19% interest on top of your 10% gain, you're looking at 29% growth, which would give you an alpha of 21%. That seems pretty smart to me. Again, I think real estate is one of those asset classes that holding real estate long-term, you're going to win long-term. I just think from a market timing perspective, I don't know if I'd want to buy a house right now. I really don't think I want to buy a house at this moment in time, just because prices are so elevated. I mean, there's a house down the street, which is, I'm not going to say it's tiny, but they listed this house at $1.3 million. It sold for $1.51 like the next day. Crazy. And I'm like, it just makes me go, should I be listing my house here and capitalize on this? Because I'm happy to rent for a year, watch the market collapse, and buy things at 50% discounts if it drops that low. So now That's a real tough one. You got to ask yourself, how aggressively do you want to buy this piece of property? If you can tell yourself that you can buy a piece of property with the current mortgage rates and whatever loan you need, and you run the spreadsheets and you say, okay, it's going to cost me, I don't know, $3,000 a month to own this home. And if you can rent that out with property taxes, insurance, and all those other variables, and you can rent that out for, let's say, $4,000, great. You have $1,000 plus cash flow per month for that real estate investment, and hopefully over time that asset will appreciate. However, I think over the next, let's say, 2 to 3 years, I think you're going to see a decline in the value of real estate prices. Just has gotten a little bit too ahead of itself. I think if you look at the facts that the Fed laid out on the table today, right? If you go back to those FOMC meeting minutes today, I think it paints the picture of it's a little gloomy, right? They're going to be raising rates much more aggressively. So if you can lock in a mortgage rate right now, you're probably good. Could we be looking at, let's see, you guys tell me, what do you, let's fast forward a year, right? So we're talking 365 days from today. So here we are, it's April 6th, 2023. Right now, you're getting a 30-year fixed rate mortgage for 5%. Type into chat what you think the 30-year fixed rate mortgage will be in 1 year, right? Going in 365 days, what do you think it's going to be? I want to bring up a chart here, see if I can find the 30-year mortgage rate. Just so we can, as a reference here, right? This is the best rates that you can get, apparently. Yeah, here you go. Yeah. So type them in. Here is a list of what they are today. 30-year fixed is 5.381. Crazy. 5.381. So less says 6.5%. Okay, I'm going to leave this chart up here so I can hopefully get some more comments from you guys as far as what you think the rate it will be. Bo, you think 4.25? No way, man. No way. Can't be. It can't be, Bo. I think it's mathematically impossible. So I got 4.25, 6, 7.25. Interesting. I will take a note. And Michael says 9. And just imagine that, Michael. You put 9% on there. Imagine what that does to anybody looking to buy a home. Naum says here, investment property, right? Well, it might be a great investment property with a 3% mortgage, but you get to 9. I don't know. I don't think that's gonna. You're gonna price a lot of people out. So let's just put it into perspective here. If you look at where we are right now, the market with this 2.6 has priced in the current current rate increases. But you can see, let's go out to, current reading is between 25 and 50 basis points. That's where we are right now. Okay? If we were to stay there, yeah, we would probably see maybe 4% rates. I'm glad to have locked in it. Yeah, me too, Daniel. I'm really glad. I got sub 3, but mine's a 15-year, and I thought it was amazing that I got that rate. So if you look here, and just count them in 25-cent increments from where we are today. So if we're at 50 basis points, you've got 75, 1, 125, 150, 175, 2, 225, 250, right? So that's 8 increases. And if I look at this chart, here is December's meeting. They're saying 250 to 275. So 8 increases means a 1.5% increase from current levels. And if we're currently at 5.38% on that 30-year fixed rate mortgage, that means that realistically we should be about 6.8 to 7% next year, 365 days from today. So, as Naum, since you brought the question up, I think you really, Bo, you don't have to retract your answers, buddy. I'm just playing with you. Don't worry. No offense taken. For Naum, this is right now you are at a critical decision point. You're like, man, do I take advantage of cheap money because the future is pretty much certain of higher rates? I almost guarantee that we're going to see the rates higher by the end of the year than they are right now. Almost guaranteed. Nothing is guaranteed, but that's a pretty solid one. If you're looking to buy, you got relatively cheap money still. 5% is still a fairly decent rate. However, what about 7? What about 8? What about 9? I don't know how quickly this escalates, but just putting those facts in front of you, those are the numbers. The trend is clearly up. You can see here on the 10-year that trend, for anybody here who is a trend follower, which is most of you, you can tell that not only is this trend strong, it's accelerated aggressively, and you might get a real big spike here, challenging this 3.26. If we get that 3.26, hell, next year you could be looking at an 8% mortgage, which I think is way, way too aggressive, but you never know what could happen. Lori says, my mortgage is 2.87 adjustable. Oh, boy. Oh, man. Ugh. Sorry, Lori. Adjustable rates, man. That's a brutal one to be in right now. I couldn't usually have one more adjustment, but your next adjustment is going to be high, right? You're going to go from 2.87, depending on when it adjusts. You could see a pretty big pop. Good news is it'll be paid off, but your last payment could be significantly higher than what you're currently doing right now. In an environment like we had back here, if you look at this, the 10-year, and I can see why people liked adjustables. If you look at the trend here, here's a weekly of the U.S. dollar, of the 10-year, those yields were just dropping and dropping and dropping. So, if you were in 30 years on a adjustable rate mortgage, it was awesome because it seemed like every year when your thing got recalculated, you were just paying less and less and less. Although your last little bump here could be a steep little pop. Let's see. I had a couple of questions that came through here earlier. How about taking a poll of how many of us refied under 3.25? If I could just ask. I think for anybody who had a mortgage, when you saw those rates get under 3%, you should have refied. I mean, even if you were like 4.5, which was a great rate to be. I think when I bought this house, this house was 5, and then I refinanced and got into that sub 3, but I switched over to 15-year, which usually gets you a little bit cheaper rate. I did not consider buying real estate, but not at these. I did consider buying real estate, not at these levels. Yeah, I'm right there too. I want to buy real estate. I see that I want to put some capital into real estate because I actually sold most of mine over the past couple of years. I just have a couple of properties left. But as Naum says, inventory is the problem, right? You just don't have a lot of people selling, and you have a lot of people that want to buy for investment properties. To me, what that creates is a little bit of a bubble. And I think you got to be real careful there and tell yourself, if I am going to buy something right now as an investment property, what is the realistic expectation that I can pay for everything, meaning property tax, income, all that stuff, insurance, all of that? What's that nut number? And there may be a time where you are going to fall short of that a little bit. Now, the good news is, as we have, I don't think rentals are going to be disappearing. Rentals will always be good. Cool. All right. Well, so those FOMC meetings, that's really the two main takeaways I had was, look, they're going to have a much more aggressive time with rates, but we talked about that yesterday, so that was no surprise for me. Remember, we look at this chart, and again, I would encourage you guys to check this site out. I really enjoy this one. It's kind of nice to see what the market, and I mean the real market, not the Fed. Sure, the Fed dictates what the market ultimately does, but the people who are buying these futures contracts are traders putting real money on the line. So I trust people, especially in the institutional level. Well, let me take that back. I don't trust them. But I like to see what those people are thinking and how they're deploying their capital in these markets going forward. So this is from the CME group. If you want, I can post it in the chat. I did yesterday, but if you want it again, let me know and I'll put it in there. And then the second part was looking at rising rates. And this is going to impact us all. This 10-year doesn't just mean that the cost of a mortgage is going up, it's the cost of borrowing money. So as we look at these colossal earnings of companies, right, we've had just great earnings and great growth, and especially with all the stimulus stuff that's been going on, a lot of good numbers. But if the cost of capital starts to get too high, that could start to slow down businesses, it's going to slow down consumption, and again, it's going to take a while to get there. Lori posted on the YouTube page, says, Get Don Fron back on the show. Sure, we'll get him on. He's welcome anytime. And the other part was, do I think that the high for the year is in? I still do. Yeah, I do think it's in. Even though I drew this out the other day, which I think is a very interesting view on the markets, which was that this S&P, let me just shift this over here. I believe the number I had was it moves 28% after the yield curve inverts, and that's where this little red line would be. And that's showing you a 28% move to the upside. So, in theory, it should still be going up and making new highs, but I think the proverbial "this time is different" is true. I think that this time is going to be a little bit different, and, we're not that far off the all-time high. So it's a little bit, aggressive for me to say we're not going to make all-time highs. I just think that there's a little bit too much dark cloud forming over the markets after just this ridiculous market move. Whether you look at it normal or for you guys out there that are logarithmic fans, you look at it logarithmic, it still is saying we are due for the mother of pullbacks, and this has been fueled by the Fed and all this buying. So If the Fed is removing money from the table and we have all this rate increase talk and aggressive rate increase talk, could we be looking at 2,200 on the Dow or S&P? Sure, right? That's a 50% drop. Let's just put that in perspective for everybody. If we go to the all-time high, which is right, let's call it 4,800. If we went down to 21, which doesn't even seem like that bad, that's a 54% decline. And that would be where this red line is. Would you guys think that would be like apocalyptic? It would seem like it at the time, but really, grand scheme of things, it's not. It's really not. It is just a big pullback in the overall move that brings us right back down to a demand zone that goes all the way back to 2020. Right? The market would have to drop 50% from its all-time high just to get back to the lows that we saw in March. Just to put that into perspective, that is a ridiculous market gain fueled by money. Just for fun, I look at a screenshot of our rate guesses, and we'll send it to you in here. Yeah, I was going to write that down, Michael, just for fun as well, and paste it on my monitor. I have a spreadsheet that has all of our S&P guesses for the end of the year as well. But again, it's all just opinions. It's all speculation at this point. The only thing that's true is what the market did, right? When it's done and finished, then we can go, see, I told you so, or man, I was way off and I was wrong. Hopefully I'm right more often than I'm wrong. Okay, so those were any other questions you guys have about the Fed, let me know. Send them on in. I don't think there was any real big surprises. What was great was to hear them say they're going to outline starting in May. It'll be official. They're going to say, we are going to start unwinding, and they will give us a starting date for unwinding the balance sheet. At that point, I think you'll see the dollar start to really truck to the upside. So I have a question I want to get to that I really wanted to spend more time breaking this one down for everybody. I just haven't had time. Now, I have downstairs in my office a library of books. I literally have been given, I would say probably given through trade shows and just some events and publishers sending me books. I probably gave away at least 100 trading books the other day. I literally put them in a bag, and there's a friend of mine down the street. He really wants to get into trading. I'm like, here, take whatever books you want. The rest, I just took a huge bag to the Goodwill. So they'll be flooded with the Salvation Army, flooded with trading books right now, which I think is kind of funny. But Harry asked this question, which I think is an interesting one. He says, Merlin, could you recommend your top books for traders? I'm currently reading How to Become a Successful Trader by Ned Gendevani, and I'm looking at other books on price action, technical analysis, and would be keen to know your thoughts. So, as a bitter cynic of the financial markets, where I believe that most people are just ripping everybody else off and stealing someone's strategy, relabeling it themselves, and pretending they're some kind of guru, I really like to read trading books. It's like, would you like to read a book on how to swim, or would you rather actually get in the water and swim? That's my view of trading books. And I apologize if I sound like a condescending a-hole, but look, most of the books that you're going to read out there, how many different ways can you explain MACD or how to use stochastics or Bollinger RSI? I mean, I could write a book today on technical analysis. Just throw a bunch of screenshots and here's how you do it. I mean, you guys have seen how I explain candlesticks, right? That is my personal little tweak on candlestick strategies. I could write a book on that. I think most of it is just regurgitated information and how somebody tailors their strategy. So there are a couple books that I think are important for, number one, to understand the market dynamics overall and get a sense of history. My number one read is nothing about technical. It's nothing about, hey, here's a strategy book. The book is Reminiscences of a Stock Operator by Edwin Lefevre, which of course everybody thinks is Jesse Livermore, who apparently, there's a book on Amazon called, let me see if I can find this one for you because I thought it was interesting. It's called, let's get it there, The Greatest Trader of All Time, Trader. I think that's what it was called. So I'll go to here. The Greatest Trader is a book on Amazon. Oh, I could have sworn this is a book. Maybe there it is. Lessons from the Greatest Stock Pickers of All Time. No. It was called like The Greatest Trader. One second. World's Greatest Trader. It was about Jesse Livermore. So there you go. Jesse Livermore, the world's greatest stock trader. Just for show of hands, how many of you think Jesse Livermore is the greatest stock trader ever? I mean, you may not even know who Jesse Livermore was, but if you think he is the greatest trader ever, then just let me know, and I can slap you to the ground in a matter of seconds. Here's why. I'll ruin Reminiscences of a Stock Operator for you, but here's why Jesse Livermore, it's impossible for him to be the greatest trader ever. He started off with a few dollars, right? Just a few dollars. And this is back when they were called bucket shops back in the late 1800s. He started off with these bucket shops with a few bucks and turned it into, hundreds of thousands, which for the 1800s, that was like, oh my God, this is amazing. But then he lost all of it, every single penny. And then he borrowed some money, did it all over again, made tens of millions, and then lost it all. There is no way that anybody can proclaim or be called the greatest trader ever, or even, I would say, a great trader, if they lose everything they have multiple times. You lose everything you've got one time, you blew your account, you better regroup, listen, evaluate your trades and be like, I'm never doing that again. This will never happen to me again. But if you do that multiple times, I'm sorry, you're not the greatest trader ever. You just cannot be classified as a great trader if you lose every single penny you have multiple times. Anyway, I do believe that the book, The Reminiscences of a Stock Operator by Edwin Lefebvre, is a great book. It's more of a novel. And Laurie says, I like novels to relax with. To me, that's more of what I think Reminiscence of a Stock Operator is. Now, I guess I'll just keep this up here as I'll run through. When I started to really struggle, so back in the late 90s, I went on what I call a downward spiral. And that downward spiral was I was just losing every day. I would just invariably, and I would actually come into the mindset of, man, I'm going to lose today. And it just, I almost became a self-fulfilling prophecy on how to lose money. So a friend of mine told me to go home, regroup, think about stuff. And I read this one, The Disciplined Trader by Mark Douglas. So I read this book, and I really liked this one. It was from 1990. You can probably find it, a PDF of it out there for free if you want on the internet. But Disciplined Trader by Mark Douglas is one that I actually really liked. It's much more about psychology, and I'm a huge fan of psychology. I don't believe personally that trading is about analysis. I don't really think it's about analytics or metrics or any of that stuff. I think it's how you react to things and how you deal with challenges as they come your way. If somebody throws a ball at you, do you just stand there and let it hit you in the face? Or are you going to catch it or move out of the way? Right? These are things you have to think of very, very quickly as that situation develops. And I think trading is no different. What makes trading more interesting for me is you have ways to deal with everything that's thrown at you. And every now and again, I know many of you have been caught, right? The market catches you with something. Well, that's the fool me once, shame on me type of thing. Or fool me once, shame on you, fool me twice. I don't forget how that stupid phrase goes. I feel like George Bush right now. The first time it happens, okay, you screwed up, learn from it, don't let it happen again. But if that mistake keeps happening, then, that's on you. You got to fix that type of stuff. So I think psychology is the most important piece by far in trading. Fear, greed, emotions. I mean, every one of you, if you've actually traded real money, especially if you traded big, you get those sweaty palm days where you get really nervous. You do the catatonic rock where you sit in your chair and you just rock back and forth and stare at the screen. Dr. Woody's book is great, which is called Secrets of the Peak Performance Trader. Another one I really like is Dr. Alexander Elder. Of course, this guy just wrote books over and over and over. It's called Come Into My Trading Room. Come Into My Trading Room by Dr. Alexander Elder is another good one, right? And this is a bit more of trading mechanics, but there's definitely a lot of psychology in this one. So Tom Davis mentioned. So those are the main three that I would say are really good. I think the sooner you forget about all the technical analysis, mumbo jumbo, meaning, I've got books by Martin Pring. I've got probably 20 books downstairs that are this thick, like War and Peace type novels on technical indicators and analysis tools. Forget them. Don't waste your time reading all that stuff. If you want to learn how a technical indicator works, ask me. I can tell you what pretty much every indicator works because I've worked with them. I've traded real money with these indicators. And yeah, I've read some books on them, but mostly it's application. Do they really work? Now, I might be slightly biased in my application of these and which ones work and which ones don't. I think that by themselves, none of these indicators work by themselves. In conjunction with a strategy, with rules and a plan, then they can work. And they really ultimately become like a crutch for you, right? Where they just kind of help you wade through the markets and say, okay, here's either how I'm scanning and filtering for things, or how I'm actually going to be executing, or how I'm setting my stops, or how I'm managing a trade. Those are what indicators are useful for. Don't buy technical analysis books. Don't buy an Elliott Wave book. Don't buy a book on Fibonacci's. You don't need it. Save your money. The psychology stuff, though, I think is important for you to hear case studies, because it'll start to hit you personally and you'll realize that, hey, you know what? I have some changes I need to make to my trading. All right. Sorry, I'm ranting. What's another decent one? Now, I personally do not recommend buying this book just because it's so unbelievably expensive. Stephen Bukowski, wow, we're getting underwear or something? Well, it was called the Encyclopedia of Chart Patterns. Maybe I spelled it wrong. There you go. I spelled it right. The Encyclopedia of Chart Patterns. This is one that really helped. Thanks, Lori. This is one that really kind of helped me understand probability. And I am a firm believer that if you take a gambling scenario, so anybody here goes to Vegas and does roulette, you do craps, you do blackjack, whatever, you are gambling because the math is clearly in favor of the house. They wouldn't have a game that was 51% chance that you would win as a consumer. It's going to be 51% chance that you lose. And over time, you're just destined to lose more money. That said, there are strategies that you can implement that, if done correctly, and you have to really be meticulous about it, can actually steer those odds in your favor. And that, to me, is why I love patterns. I love ascending triangles. I love pennant formations, head and shoulders, wedges. I love looking at the formations of price because, to me, if you look at every single transaction that happens on a price chart, right? We can just take a peek at any one here. Every single transaction that happens on, let's say, this S&P 500 here. Let's pick a different chart that's not marked up. Every single transaction is painting a picture that we can see on a much broader picture. For example, here's our daily, right? So we can see that the Russell 2000 has been traversing sideways, which tells you there's really no clear direction. We broke out. Now, at the time, that looked like a breakout trade. Go long. Well, it came ripping back down the next day, and now all of a sudden we're stuck back in the yellow box, right? So this is a study of behavioral analysis. That said, I can go in here and go to a 1-minute chart or a 1-tick chart and really see the behavioral patterns. Because remember, every one of these transactions that happen on a 1-minute basis is a part of a bigger subset on the daily or the weekly or the monthly. So for me, I love looking at price patterns. And what I would encourage you to do is you can just go to Google and type in Encyclopedia of Chart Patterns.pdf, and you can probably get that book for free. And then play with it a little bit. You know, find patterns that you read a chapter on. I don't know, pick any pattern. Call it ascending triangles. Like, okay, I like ascending triangles. Yes, Tom, going sideways is a direction if you're an options trader. Absolutely. If you're, for the most people, you're not going to capitalize on it. But especially something that's range bound. Awesome. But find a pattern in the Bukowski book. Just flip through blindly, flip through the book, hit a page and go, okay, I'm going to read up on this pattern here. Whatever it is, go out there and see if you can find filters or see if you can spot them in the markets and understand the statistics behind, because Bukowski has all of these, all this analysis on if the market's trending up and you get this pattern, there's an 85% chance of it breaking out and working. He has all those numbers based off of millions of charts that he's analyzed through computers. So to me, that is a very... Okay, thanks, dude. Someone, you just got blocked. I hate when I have spammers on here, as you guys know. Why can't I... There he is. And remove that user. How do I block that? We'll just remove that user. Hide user. See ya, someone. Pumping Lake and Rose. You're laking out of here. All right. Sorry about that. So... let's go, and just as an example, there's one site that's free. It's called FinViz. All right, go to finviz.com, and when you get there, there's all kinds of free data here. Of course, you can pay for stuff, but I like free. But notice right here, there's a whole section on ascending triangles, descending triangles, wedges, double tops, double bottoms, head and shoulders, channels, right? All of these are really important pieces, but not all of them are great. So if you look over here, let's go to an ascending triangle, right? That means that prices are moving up. This is pretty much what you're seeing right now in the dollar index. You're also seeing it in the bonds. So let's go over here. And, any one of these could potentially be a trading opportunity for us. Now, here's EQS. It's a $3 security, $2, and not really that great. I'm not that interested in this one, so I would remove that one. This first one actually looks pretty good. ACAD, right? You've got this relatively same horizontal line right around 27 bucks, but notice the uptrend. Higher lows, higher lows, higher lows, higher lows, but the highs are staying the same. So it's compressing, and eventually, what happens when something compresses? If you take a spring in your hand and you keep compressing it, but you keep that top finger the same and press that bottom one up, ultimately that spring is going to shoot out. And bam, it goes launching. That's the essential part of an ascending triangle, right? You're looking for the breakout to the upside. Some of these are absolute trash. Ooh, this one's actually pretty nice. ABTX, right? ABTX, higher lows, higher lows, higher lows, higher lows. But since November has not been able to break 46 bucks. So you got a multiple top here. You've got move to the upside. I actually like this one. Let's go ABTX on this chart. And if I'm just rambling and saying stupid stuff, just let me know and we can move on. But you know, this chart here on Allegiance Bank shares, that looks poised for a breakout. Now, that doesn't mean I'm buying right now. I've got two different ways to play this. I can play the uptrend line and say, all right, I'm going to buy when it comes back down to that trend line, which so now's a buying opportunity. Or I wait for that breakout trade, which looks great, actually. I mean, if you can get a breakout trade above that 46 bucks, you know, this thing's probably going to have a pretty big rep. So, you know, this is how I like to just simply look at a pattern, evaluate it, understand the buyers and sellers that go on behind the scenes here. Another book that you can get for free is just go to Google. I'll do it through Amazon, but you guys can just go to Google and find this one. It's The Art of War. Art of War, I think, is just a brilliant book, and there's actually a couple different versions. There's some really cool coffee table versions. There's some that have been adapted just to trading. So for those of you out there, you can actually find let's see if I can find the one. Let's just do it here real quick. Let's go to Art of War trading.pdf. So there's one that is specifically designed for trading, but I'd have to spend some time to find it. And it's pretty cool because there's all these kind of phrases and slogans on how you would understand your enemy and know your terrain, that type of stuff. And those are probably the only books I would really want to read. Or something like Lori says, more like a novel, so Reminiscence of a Stock Operator. I want to see Psychology, so Dr. Woody Johnson, Secrets of a Peak Performance Trader. You have Come Into My Trading Room by Dr. Alexander Elder, The Disciplined Trader by Mark Douglas. You know, Bulkowski's Encyclopedia of Chart Patterns, I think, is a great kind of overview of patterns. I believe that patterns are just a simple representation of behavioral analysis. It's showing you what people are thinking. So you see fear, greed, and emotion in patterns all the time. Oh, the other one, which definitely do not buy this one, but it's just Candlestick book. What's it called? The Encyclopedia of Candlesticks? NCYCL. It's by Steven Nissen. Oh, maybe Bukowski did as well. There's multiple books out there on candlesticks. They're really expensive. You can get a PDF for free, so don't bother with that one. But Steve Nissen has the book. Let's go Candlestick Charts and type in Nissen. He is kind of the guru of the industry. Yeah, there it is. Japanese Candlestick Charting Technique. So I own this one. I haven't done Beyond Candlesticks. But here's the thing I don't like about candlesticks for everybody out there. If you look at a candlestick, remember, one candle represents X amount of time and X amount of transactions. So if it's a 5-minute candle, it's 5 minutes from beginning to end, and whether that's one transaction, 0 transactions, or 5 quadrillion transactions, they're all reflected in that one candle. By itself, that can tell you a lot, but the thing with these candlestick books are they try to explain every single pattern that's out there. I mean, it's you want 1 candle, 2 candles, 3 candles, there's a pattern name for all of them. Abandoned babies, falling windows, homing pigeons, you know, it's just stupid. Learn the few basics. And the ones you want to learn are the ones that most people are looking for. That's hammers, shooting stars, bearish and bullish engulfing formations, bearish and bullish harami. Some would call them the three white soldiers or 3 black crows. Those are cool ones as well. You have dark cloud covers. Those are pretty unpopular. Thanks, KF. Yeah, smash that like button. I go on vacation. I lose a lot of people watch this show. I got to stop going on vacation. We were just tipping on 100 people watching live today. Now we're at 50. Well, we'll get back up there. Anyway, so those are my books that I would recommend for everybody. Again, if you can get them out there for free, try to do so. And pretty much every book you can find, just go type PDF and you'll find it so you can add it to your Kindle or your Nook or your iPad. Let's see. Yes, Alan, spammers are here. What other way can we track institution and bank trading cash flow instead of demand and supply zones? You know, there's a tool out there called On Balance Volume that a lot of people like to use to kind of show you where the big transactions have happened, because I mean, arguably, the institutions are trading way bigger than you and me. So they're going to have, 100,000 shares at a time, 500,000 shares, and that footprint can be reflected on balance volume. So you can see where a bulk of the transactions happen. That's one that I think can be helpful with normal supply and demand, especially if you can line those things up. Other than that, you just got to watch time in sales or prints. Watch when these transactions come through. The thing that's changed over the years is the ability for institutions to mask what they're doing using reserve orders, using iceberg orders, dark pools. So it's much harder to read NB than it was before, significantly harder than it was before. But I'm just looking at the development and shape and structure of a level can give you a clue. How something comes into a zone, how it leaves the zone gives us little clues as to the footprints of institutional involvement. What stable coins do you recommend with the best yield and security? I'm not really concerned about the security side of things because most of them are on the Ethereum blockchain, which hence gives them the security. If you look at something like Tether, Tether's kind of a scam. Tether has got all kinds of crazy crap in it. It's not backed by US dollars. It's got a small piece. You could look at something like USDC, which is backed by physical US dollars as well as treasuries. You could use Paxos, which is supposed to be backed one-to-one. True USD also. These have been audited cryptos. So it's more important that I have the knowledge and the verified auditing saying that there is actually something backing the stablecoin. With Tether, you have no clue what's backing it. It's a mystery. As far as where you stake these things or put them in lending protocols, that's on each individual person. You could use something like UST and put that on Anchor Protocol and get 19%. You can put them on Crypto.com and be getting, it used to be 14, now it's like 10% for those different cryptos. So, and each one of these exchanges, whether it's Nexos or Voyager or Crypto.com, Celsius, BlockFi, Abra, they all are going to have different provisions put in place and insurance. Some of them don't have insurance on their holdings, which should be a kind of a red flag, at least make you a little bit nervous. Crypto.com recently got an insurance policy, so does Nexo. So they have, if they were to get hacked or something happens, your funds are going to be protected. So I would probably say USDC, UST, not USDT, but UST, which is the Luna stablecoin. Or Terra USD. Then you have what else? Paxos, USDC. What would you do else? A DAI, I guess you could use DAI as well, but that's an algorithmic stablecoin. That's not backed by anything. Neither is UST, right? Those are algorithmic stablecoins, which in theory have nothing backing them, whereas USDC and Paxos do have things backing them. Look for a large open interest in the option chain. That's one way. It's interesting, Tom, that you mentioned that because I've talked to a lot of options guys, and I said, what about looking at open interest as a clue as to where something may be going or where a supply and demand zone exists? And most of the options traders I know are like, doesn't mean anything. I was like, really? Because someone sold those options at that level and someone bought the options at that level. I mean, why is there that much interest at that zone? Certainly, it might be something that's beneficial. I've tried to use it over the years. I found it really didn't help me too much using open interest on options. Okay, tomorrow, let's take a peek here at what happens in our market so we can kind of seed for tomorrow. Obviously, crude oil having a brutal day today, which is interesting because up until today, it was forming a pennant formation and actually looking like it's getting stronger and stronger and stronger, just a little consolidation. Today's move makes me kind of question the future upside here. Do we come back and challenge this $91 mark? It feels that way. It really does feel like they're drifting back down towards the zone, but of course we have to get below these lows from March. You also have, sorry, my voice is going out here. You also have with natural gas has been kind of wild lately. Notice the nice shooting star formation today, came right back into those highs from back in September. I'm going to have John Rowland on the show tomorrow. And John Rowland is going to talk to us about natural gas. He was saying it's going much higher. He has a very interesting forecast for the market, or at least for natural gas going forward. We'll talk about crude oil, talk about natural gas, maybe some contango pieces, but I know it's more of a geeky dive into the future side of things with John Rowland, so that will be our guest for tomorrow. If you guys have any comments, questions, feedback, put them down below the YouTube video. So go to youtube.com, go to the TraderMerlin channel, and click this video, put your comments down below it, or email me at tradermerlin@gmail.com. That said, This was supposed to be a 30-minute show, and here we are at 51. Hope you guys have a fantastic remainder of your day. Lori, I don't believe Voyager is insured. I don't see them having an insurance policy, so should make us a little nervous, but nothing to freak out about, but that's just a little extra security blanket knowing a company does have insurance. All right, everybody, that's going to do it for me. Hope you enjoyed today's show. Hope you enjoyed Mr. Powell's most recent moves with those FOMC meeting minutes. I am looking forward to what's going to happen with our markets going forward. Speaking of forward, let me show you this one real quick. I was just going to wrap up. You do have tomorrow retail sales for Europe. You have all kinds of other economic data with 10-year for Spain and for France. You have German industrial production, Halifax HPI for the British pound, and then notice here's a bunch for the U.S. Unemployment claims. You have two FOMC or an FOMC member speaking, natural gas storage, consumer credit, and then pay attention to Janet Yellen. Janet Yellen has been very interesting with what she's been saying about cryptocurrencies in the last couple meetings. So anyway, hope you guys enjoyed that one. That's going to do it for me. I am out of here. Email me at TraderMerlin@gmail.com or put your comments down below the YouTube video. I will see you all with John Rowland talking commodities, natural gas, crude oil on tomorrow's show. Take care.